Start with the recording. All right, great. So we're recording. Welcome to the My Community, one of our weekly sessions. We have a special guest today. We're very grateful. Stephen Hamilton, who's an enrolled agent. He's an NTPI fellow. We've got his picture here on the slide. He's also live and in person. So we're really thrilled. He's a great community member. You can connect with him on the My Community site, and you can message him, or you can also, we'll have his contact information at the end. So thanks for joining, Stephen.
Thank you guys for having me.
Excellent. And so, as I was mentioning before we got started, we have a lot of folks that have RSVP'd for this session. It's a great topic. Today's topic is going to be considerations for C corporations funded with a ROBS 401k plan. So these are individuals that want to start or buy a business and use their retirement money to do so without paying taxes or penalties. And so what I would say is that, let's get started. We first want to go through with the agenda just to kind of have a roadmap of where we're headed. And just to remind, this is a recorded session. As with all of our My Community webinars, you can access the recording on the private webinars group page. If you click on Zoom and then click on past meetings, then click on the meeting you want to hear, you'll be able to, it'll bring up a link where it'll say show recordings and you can listen to the recording. You can also access the slides. We have posted a discussion group. We already posted a link to these slides in the discussion group, and you can access the slides on that page. If you have questions about what you've watched, if you're watching as a recording, you can post those questions in that discussion group so we can follow up and continue the discussion there. So as far as the agenda, what we want to talk about, first set the stage as far as what is a ROBS 401k. We'll talk about some of the key requirements for a ROBS C corporation. And then we'll go through some good FAQs that we often hear. And I see we've got some folks joining. Thank you so much for taking the time to join. We're just going through the agenda. If you have questions, and please let me know if you can't hear. If you have questions, if you could please use the chat feature of the Zoom to chat those over to keep things organized and orderly. We'd really appreciate that. But as I was saying, we're going to go through FAQs that we often hear from existing or prospective clients who are thinking about using their retirement money to fund a business, and specifically related to a C corporation. Because Stephen here is, as I mentioned at the beginning, obviously he's a tax expert, being an enrolled agent and an FTPI fellow. So we want to give Stephen a chance to share his good knowledge. So what I'll do is I'll continue to set the stage. We also want to give a disclosure that this presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice. When making an investment decision, please consult with your tax attorney and financial professional. So before we give Stephen a chance to share his knowledge, we first want to set the stage as far as what is a ROBS 401k. So it refers to a rollover as business startup transaction. That's the IRS terminology. And what it's doing is it's allowing you to use retirement money to start or buy a business without paying taxes or penalties. So there's certain key requirements. One of those is that you have to have eligible money. So you got to use money from a former employer plan or a non-Roth IRA. You've got to use the money to start or buy an active business. So it's got to be, it just can't be an investment vehicle or, some type of passive activity. It needs to be what's referred to as an operating company, which means it's providing goods and or services. It has to be operated as a C corporation. So obviously we're going to dig deeper here in today's session about what that means. You have to be working as a bona fide employee, at least 1,000 hours per year is the guideline. As far as the process, you would start up by incorporating a C corporation. That C corporation sponsors a 401k plan. You roll your money over from your pre-existing account into that new 401k. So of course, that's not going to be a taxable transfer because it's going from one retirement account to another, then that 401k, we are the IRS approved sponsor of that plan, which allows you to invest in the stock of your new employer, meaning that C corporation. So you would invest the 401k funds into the stock of the C corporation. So the money is now in the C corporation bank account. The company can use those funds for any type of legitimate purpose, including buying or starting a business. And the money hasn't left your retirement account because you really just made an investment in the stock of your employer. So therefore, it's not a taxable distribution. In terms of some of the key requirements for the ROBS Ccorporation, to start to dig deeper into it before we turn to the conversation with Stephen, the business that is funded, again, with the retirement money must be operated as a C corporation. It cannot be an S corporation. For example, you have to file an 1120 at the federal level. You must work. Again, you got to be a bona fide employee. Once the company is generating income, you may receive reasonable compensation that's paid to you as an employee, W-2 wages, in other words, not as a 1099 independent contractor. You can't, your only relationship with this company is going to be an employee and a stockholder through the 401k and then personally. So you can't be a lender. You can't personally loan funds to the company. If you make additional investments, that's going to be structured as another stock purchase, which would have to be done at fair market value at the time of the subsequent investment. Likewise, you can't borrow from the company. And lastly, one of the bullet point here is that the C corporation can't interact with another entity that you own personally. For example, the C corporation can't lease real estate from an LLC that you own personally. So if you have that real estate in the business, you could have it as a subsidiary LLC or owned directly by the C corporation, but not owned by you personally, where the C corporation is then paying you rent, or an LLC that you own rent. So now that we've set that stage, what I'll do is I'll go through these FAQs and then we'll let Stephen chime in from his perspective. So with our first FAQ that we brought to the session, we say here, I've invested $90,000 of my retirement funds in my business via a ROBS 401k. I previously spent $10,000 out of pocket on startup expenses. I know that I'll receive stock personally in exchange for incurring such startup expenses. In other words, let's say 10,000 shares to you personally on account of the $10,000 that you spent out of pocket to get the business going, and then 90,000 shares issued to the 401k on account of the $90,000 that was invested via the ROBS 401k. Can the C corporation claim those amounts as a deductible business expense? So we hear that a lot, Stephen. So I'll let you chime in.
That's actually a great question with a threshold question in there underlying. So there's two separate transactions. There's the contribution in exchange for stock, and then there's the fact that the entity is incurring those expenses. We have to think about, yes, it feels like it's one transaction, but it's in reality two. So the corporation can still deduct those expenses. The fact that you had spent them and then you're getting reimbursed with a stock is in reality a completely separate transaction. They're just kind of lumped in there when you're actually doing it as one. So the corporation will treat those as typical startup costs. I don't know how much additional startup costs in this case it will incur, but it would then follow any typical standard business startup costs. Typically, your first $5,000 or so is currently deductible, and the remaining has to be amortized over 15 years. So not intentionally a two-part question, but I wanted to answer the underlying in there. The short version is yes, it can claim those amounts as deductible business expenses.
Awesome. Great information. Yes. So yeah, that's the way I think about it, right? That as between you and the company, you're buying stock in the company. So you get your 10,000 shares, and my simple explanation. But from the company perspective, it's an expense. And so it's, as Stephen explained well, it's treated like other startup expenses. Great. Next question. I've invested $250,000 to start a mobile home repair business. I need to start using the funds to pay for expenses, including buying a truck for the business. How do I determine what is a reasonable business expense? So that's a classic question from our perspective. I'm sure, Stephen, you share that experience.
Yes, we run into this all the time. And there's two very clear paths that we can utilize. First of all, a reasonable business expense is anything that is ordinary and necessary to the business. That's relatively clear and defined. The tax code itself uses the phrase ordinary and necessary. If it's a mobile repair business, obviously it's going to be ordinary and necessary to have a truck or other vehicle that's vehicle use. Now, whether or not it's the business's truck or your personal truck, I would try to avoid any type of typical passenger vehicle for this type of situation. I would encourage it to be owned directly by the business, financed by the business, and fully held by the business. You don't want to use that truck to go out to help your cousin move. You don't want to use that truck to go out to the store to go get groceries. On the other side, based on the veil of the C Corp, if you are using your personal vehicle for any business expenses, then what you need to do is you need to set up what's called an accountable plan. And it's essentially a reimbursement policy. So just like you would with any other employer, you would fill out an expense report while you're wearing the employee hat. You're going to turn it into HR. So you're going to run around to the other side of the desk, put on your HR hat and say, thank you for turning in this expense report. We'll cut you a reimbursement check with payroll next week. And that's how you would then operate that. You have to have a clear and defined policy for how you are operating. Because if it's ever looked at by the IRS, I want to be able to say, here's our policy that we set forth. Here's how we abided by it. We did this continuously, and we also did what's called contemporaneously. So as it happened, don't incur expenses throughout the entire year. And then, oh, it's December 20th. I need to cut myself a big, huge check for all of those reimbursements. You can't do that. They ideally should be done within that month or at the latest that quarter. So it needs to be a frequent, typical, normal business function.
Sure, right. Observe those formalities.
Correct.
Not is what I'm hearing. And just like you wouldn't wait a year to reimburse your employee.
They'd have a problem with that.
Exactly. Okay, great colored information. Next question. I don't need to draw funds out of the business for my living expenses. Once the business is generating income, is it generally advisable to take a minimal salary from the C Corporation?
I absolutely love that question.
Great.
The answer is yes and no. There is technically no specific requirement for a C Corporation to draw a salary. However, if the business is generating income and you are active in that business in any way, shape, or form, you will be in a position where you need to be paid a market salary. That reasonable compensation for your personal services. If you fail to pay a market salary, in the event of an examination by the IRS, you could be deemed by not taking a salary to inadvertently be creating excess benefit to your retirement account who owns shares of the C Corporation. So we have to make sure that the corporation does not get a competitive advantage by not paying you a salary. I have a resource that we often use. It's called RC Reports, and I want to say it's rcreports.com. And we use those reports to generate a reasonable compensation analysis for the activity, both the activity level and the actual activity and type of work that's being done. And we use those reports to help prove, not just in IRS audit, but also in determining what's a reasonable compensation to pay yourself.
Yeah, and I think that's the type of information that's super helpful for this next question, for really not so much is there a minimum, but how high can I go? So in this question, it's the other side of the equation. I left a high-paying corporate job to start a business via a ROBS 401k, and working in the business is my primary source of income. Once the corporation is generating income, I need to draw a salary. How do I determine what is reasonable?
Well,
So
I follow that same process.
That report that you mentioned, for example, would be a great resource. So what, could you tell us that again, the name of that resource?
Yeah, no problem. It's RC Reports. It stands for
RC.
Reasonable Compensation Reports.
I see. Great. So and it sounds like what that is essentially a database of what's a reasonable salary for this type of job in this type of location. Is that the type of
Yes,
thing?
that is correct. It pulls data from all different resources around the world to help determine what's reasonable for that type of job, job title, years of experience, number of hours put in. All of those will factor in.
Okay, good information. So yes, salary is always a hot topic. So let's go on to another frequently asked question. I'm starting a business in Illinois. From my online research, I'm finding that many businesses are organized in Delaware. If I form the C corporation in Delaware, can I avoid or reduce my tax liability in Illinois?
No, that's the short answer is no, you will not. That C corporation will have to register as doing business in Illinois. Now, not every specific state follows this exact guideline, but they will typically consider you to have what's called nexus or a direct economic attachment to that state. So if I'm in, and it doesn't matter if it's Illinois and Delaware, if I form in Delaware and I'm in, let's say, Nevada, I will still want to register in Nevada that I'm doing business in Nevada, that I have a business location in Nevada, and that way I can help determine where my domicile is for that business. Will it help me on tax savings? No. But that said, what it will, by registering in multiple places, you'll be incurring a bunch of extra fees. And in some cases, you could actually even inadvertently cause another state to look at your return and say, we want you to pay up because we think that you owe us. And next thing you know, you have to argue that, no, I don't actually have a business activity in that location.
So even if you win, you just spent resources to make that argument. Yeah. So exactly. I mean, for our clients, most of them are starting a business where they live and work and the business operates. All the clients are in the same state, like in Illinois in this simple example. So they typically conclude that there's no reason to set it up a company and have to maintain a company in a different state.
Correct.
But that question does come up just because of the whole Delaware, kind of like a common knowledge out there, common thinking. So, okay, great. So next one, I'm buying a business that includes real estate. My attorney has advised me to hold the real estate in a separate entity for liability protection. If I hold the real estate in 100% subsidiary of the ROBS C Corporation, can I also obtain a tax benefit if the subsidiary charges rent to the C Corporation?
Well, this is actually a great question. There is no specific tax benefit by charging rent to the C Corporation. However, in order to maintain the veil of that subsidiary and of those entities, it may be reasonable or necessary that you are actually writing those checks and following that formality. That goes back to the formality item we were just talking about before. We want to make sure that we're maintaining those checks and balances and doing things the proper way. I will also bring up that in some states, for example, Florida has a sales tax on commercial leases.
I see.
So you could inadvertently be creating an additional sales tax liability by leasing it to your own entity. So that's something you'll want to talk with both your attorney and your accountant regarding, because you could inadvertently end up actually costing yourself more if you set it up the wrong way.
Got it. Yeah, good information. So you might be able to make the attorney happy, but it doesn't sound like you're going to be able to save any taxes by going through those hoops.
That's exactly it. Sometimes what's good for tax is not good for legal and vice versa.
Next question. I previously funded my business via a ROBS 401k and am filing taxes for the C Corporation, 1120 at the federal level. Do I need to first file the Form 5500 for the 401k before I can file the tax returns for the C Corporation?
No, you will not need to file the Form 5500 before you can file the C Corp return. The Form 5500 is typically due, if I remembering off the top of my head, about July 15th annually. That C Corporation return is typically going to be due April 15th. So based on those calendar year due dates, you're
Right.
going to want to follow and get that C Corp return done right away.
Exactly. You do the C Corporation return before you do the 5500. The 5500 is due 7 months after the end of the plan year. So if it's a calendar
15th
year,
day,
it's
7 months.
July 31st or October 15th if you file a timely extension. So, but yeah, great answer. Yeah, we get that question a lot. Thank you. I previously funded my business via a ROBS 401k, and the C Corporation will start to buy back the stock from my 401k. When the C Corporation buys back the stock from the 401k, will the amount of funds used to buy back the stock be considered a deductible expense for the C Corporation?
That is a great question and a very frequent one. I actually saw somebody's book set up where they were deducting it. However, we ended up having to go and make some corrections because no, it's not a deductible expense. It's simply an equity transaction, moving it from one line item to another. So no, that stock buyback would not be a deductible expense for that corporation.
Exactly. So you're using after-tax dollars, essentially, is my understanding, for the corporation to buy back the stock from the stockholder, in this case, the 401k.
That's correct.
Okay, another great one here. We're switching it up more for somebody who's at the beginning of the process. Oftentimes, I'm weighing using my retirement funds via a ROBS 401k to fund a new business venture versus using my savings to start the business. I know that I will have to operate the business as a C Corp if I use a ROBS 401k. What are the factors I should consider in making this decision? So here, I think essentially the question is, C Corporation with a ROBS versus maybe S Corp if I use my savings.
Well, that's actually a great comparison. This is not there's no yes or no answer to this. It's going to depend on personal preference and analysis on whether or not you think certain things make sense. So what you will have to look at is what's my current tax rate versus the corporate tax rate. What will the business look like later on in life when I might potentially be selling it? Or will I end up having to liquidate the assets? Because that will probably be a taxable transaction, most likely. I will have to compare on the personal side whether or not I'm going to want to pay tax on the net profit personally, even if I may not be taking it out. I could keep going on for a very long time. There's literally a million and one different things that we can compare, but it's going to be an individual preference. But the biggest one is going to be, do I need those funds right now? Do I want it to grow? Is it part of theoretically my backdoor retirement plan, if you will? You'll have to kind of weigh the variety of factors for, am I going to need that money, midway through life? Am I getting close to retirement?
Right.
Is it a business that will potentially sell? Or is it a business where I will end up selling the client list or selling that book of business?
Mm-hmm. Definitely, yeah. That's why it's not a one size fits all. And obviously, if you want to use the ROBS 401k, you have no choice. You have to operate the business as a C Corp.
That's correct.
But it's not always it's definitely a good process to go through to do that type of analysis. So, well, that's good. That's great thoughts there, Stephen. Thank you. And that actually takes us to the end. So I don't know if anyone who's in attendance has any questions they want to chat over. We could field those now. Go ahead and chat them. Otherwise, we'll also, if anyone's doing that, we'll share our contact information. So for My Solo 401k, it's business at mysolo401k.net, 1-800-489-7571. And I think we got the right contact information on the screen here for you, Stephen.
Perfect.
Excellent. Let's see. And then we've got a We've got a non-ROBS question. Let's see if we got any. Thank you for attending. We don't mind fielding questions. I don't see any ROBS 401k questions, but we'll go ahead and knock this out. We do have a little bit of time.
Not a problem. I'll go ahead and read that out loud. Can you do an in-plan solo 401k conversion to Roth if the underlying funds have been invested in an illiquid real estate partnership? Let's say the investment has gained in value. In addition to using a 1099-R, do you need to make any state filings? This is a fun one. George, I'll let you jump on the first part about it.
Sure. So you can always do an in-plan conversion from a pre-tax account to your Roth solo 401k sub-account. There's no triggering event requirement, in other words, and it can be an in-kind conversion. If you're going to do an in-kind conversion, like with any conversion, it has to issue a 1099-R has to be issued. It's going to be a taxable event. The amount that's subject to tax is the value of the asset at the time of the conversion. So if you invested it at, $10,000 in your pre-tax account, and then you convert it later and it's gone up, the taxable amount that's issued on that, or that's listed on that 1099-R would be the value at the time of the conversion. And then of course you're going to have to include that in your income for the year of the conversion. And you would let us know about the conversion. You have an online form where you can let us know so that we can put you in the queue to be able to provide that 1099-R. And then of course work with your tax advisor to share this information so that they can include it in your income.
George, that was perfect. I do want to add something. The valuation is going to be extremely key in determining what the value of that actual conversion is. We have to make sure that we can document it and prove. Some people will say go out and get an appraisal. If you want my honest opinion, I would go out and get at least two. Thinking back to a lot of valuation court cases, heck, there was actually just the Michael Jackson estate court case, which was all about differing opinions on the valuation of assets. We want to make sure that we can show, hey, we made our best and most reasonable effort to say that, hey, this asset is worth, you say it started at 10,000, that it's worth, let's say 100,000. We have two appraisals. One says it's at 99, one says that it's at 101. We averaged them out and we went with 100,000 right there. That would be our best case scenario for saying, here's our valuation on it. Here's what it looks like, and document that. So the biggest thing is we'll have to issue the 1099-R. Not every state requires that they actually get issued to the state itself. Most of the time the Fed will share that data. However, some states do require that they get sent out there as well.
Great. Thanks for sharing your feedback, Stephen. So perfect. And I see, thank you for bringing the question. So, well, it looks like we don't have any other questions. So thanks again for your participation, everyone, and Stephen, of course. We look forward to having me doing more of these sessions. So
yeah, whenever you want.
Have a great one.
Take care, George. Thank you.
Take care.